At Brand Secrets and Strategies, you learn how to save valuable time and money, where you learn strategies to get your products on more store shelves and into the hands of more shoppers, empowering brands and raising the bar. Hello, everybody. Thank you for being here. I really appreciate it. I hope you're getting a lot of really good value from these free weekly webinars. So let me know what topics you want me to cover, and we'll certainly try to get it on. Today, I've got the privilege of introducing you to Stu. I'll let him talk more about himself, but first of all, we're here for how to learn. You're here to learn how to explode sales with the right strategic investor. And I think Stu is the perfect person to help us with that conversation. I want to thank all the people that are helping with me, the companies that are helping me present this to you. Plant-Based Solutions, ECRM, RangeMe, Phil Lumpert, the Supermarket Guru, Promo Mash, Whole Foods Magazine, Green Circle Capital, which is Stu, the Produce Moms, Bricktown and Group, which is actually Eric, he was on before, Big Orange, Summit Sales and Marketing, Food Business Success, C-Suite Network, C-Suite Radio, Social Nature, and Force Brands. Again, I'm honored to have them be a part of this and help me raise the bar in our industry. So my mission, the reason I'm doing this, is to help make our healthy way of life more accessible by helping you get your product on more store shelves and into the hands of more shoppers, and that includes online. So as I mentioned, please help me raise the bar in natural. Share these resources with any brand wanting to grow and scale. And on that note, what keeps you up at night? Let me know. Send me a note, reach out to me, and I'll do my best to put that either on the podcast, in the webinar series, or I'll address it on YouTube. So we're here for you is the bottom line. So the next two free weekly webinars, next week, I'm going to be talking about how foolproof promotion strategies to confidently grow and scale your brand. This is a must attend. And the reason this matters is because in 2017, 224 billion with a B was spent on promotions, and it only increased sales by 2.4%. The point is, your promotional strategy is the way that you get your brand in front of other customers and new customers, potential customers, etc. But the reality is that most promotional spending is wasted. So attend that. You'll definitely want to pay attention to that one. And then the week after, Jessica Bates is coming on. We're going to be talking about thinking about equity, thinking beyond equity. And she's got some creative strategies to help you get funding when you need it without having to go through a bank. And we'll talk more about that later, but it's something that I think can help a lot of brands, especially during these uncertain times. And then also to help you out during these trying times, I am making my proven strategies to maximize trade marketing ROI course free if you use the code Trade Essentials. Now, in addition to that, there's a free trade promotion ROI calculator on my website, and it'll go into how to use that. So I just want to put that out there because I think the best way to help you grow and scale is to help you use your money more effectively. And that's what we're going to be talking about, Stu, today. So I'm going to stop sharing. And Stu, would you like to please tell us a little bit about yourself and your journey to where you're at?
My journey.
Yeah, your journey.
This could take a while. Thanks for
We got
having me,
time.
Dan. My name is Stu Strumwasser. I'm the founder and a managing director of Green Circle Capital Partners. And my shop is a boutique investment bank that focuses solely on natural products, meaning food, beverage, supplements. We're actually spinning up a restaurant practice right now. May seem like a crazy time to do so, but we actually think out of chaos comes opportunity. Do you want me to talk a little bit about my background?
Yeah, please do.
Okay, well, I'll try to keep it brief. I've been an investment professional for most of the last 30 years, which I know is amazing because your viewers are probably wondering, well, the guy only looks 29. How could that? I started on Wall Street in 1990, working for big firms. My first job was with UBS, what was at the time Payne Weber. My last one was with Oppenheimer and Company. Didn't love that part of the business. And I've also been a lifelong vegetarian. I stopped eating meat at the tender age of 14. that may not be so strange to listeners today, but when I was 14, it was 1980, and it was quite unusual. So this is kind of a way of life for me. It's very important to me to work with companies, and I'm very gratified that I get to all the time, that make better for you products, that are, helping people live healthier lifestyles, but also doing some good in the world, beyond just trying to make a buck in ancillary projects to, help the planet, the environment, other people. But in 2005, I finally got up the courage to quit working this Wall Street life, and I started a natural products company, my own. It was a natural soda called Snow Beverages. I ran that company as CEO for 6 years. Ultimately, the brand didn't make it, which was tough, and we could do another 3 episodes on that alone. But I raised millions of dollars as an angel, through angels, through small firms, for my own business as CEO, and the product was in thousands of stores. We feel very unique, my team, in that both of my partners and I have all been operators, which is kind of unusual for an investment banker or a consultant. We actually sat in those chairs, and I learned a tremendous amount. Certainly learned how hard it is to try to scale up a food or beverage company. And when I left Snow in 2011, basically a year or 2 later, I kind of started Green Circle. After a couple of years of doing a few other things, we did some healthcare stuff. We kind of decided to hone in on what we know and understand, which is consumer, and specifically food, beverage, supplements. And that's pretty much been the focus of what we've done for the last 5-6 years. And like I said, we are launching a restaurant vertical and are expanding into 1 or 2 areas that are kind of adjacent, but that's who we are. Our typical client, we used to say like 10 to 100 million in revenues, but until a year ago, the preceding 5 years, the space was so hot that you wouldn't see a lot of 60-90 million dollar natural food or beverage businesses that remained independent. So it seems like the vast majority of folks that we talk to as prospective clients fall within a pretty narrow band between like 10 and 50 million in revenues. And that's been what we do. Half of what we do is sell companies, and half of what we do is help raise growth capital for early stage or growth stage companies in the space. That's something not every middle market investment banker loves to do as much as to get a good sell side M&A assignment. My team embraces it. We believe that there's tremendous opportunity to kind of pick out who might be the next great brand, and to partner with those folks. And we're a little bit more flexible than some of our competitors in being willing to work sometimes with something that's a little bit smaller, a little bit less out of the box, because we kind of see ourselves in the guise of a merchant bank, where not only do we act as middleman to connect capital to companies, but we're also making an investment, in this case with our time, and we take some of our compensation in the form of equity options. Once or twice a year, we find something we really believe in, and we look to be long-term partners to those growing companies. Anyway, that's kind of, excuse me, that's kind of the basics on us. I should probably stop there.
Actually, no, that was great. I really appreciate it. And the reason I wanted you to share that, and the reason this matters so much, is that you're not just a credit, you're just not an ATM machine. You're not just a bank where someone goes in, you're cold and steal, et cetera. But more importantly, you've got that relationship with the industry, that understanding of the industry. And the reason this matters from my perspective, Stu, is that the brands that are looking for investors, you've got a choice, as we were talking about before, where you can just go to someone who is quote unquote the money, as you said, or you can go to someone who understands the space. And the reason this matters is because I think a lot of the brands in this space that are trying to figure out how do I raise money are sometimes making the mistake of just choosing the money over someone who understands the space. And so the expectations of the brands sometimes, I find, are more about how do you return an investment? How do you return growth to the investor, as opposed to what does the long-term vision look like? How do you align with the customer? What is the potential down the road? Can you talk a little bit about that and why that matters?
Absolutely. Yeah. I mean, I think you nailed it. And we spoke about this, you and I, a little bit in advance, but, there's kind of a spectrum. Well, there's two things to unpack in there, right? It's my firm, why we have a specialization, and some guys in my industry do, some don't. And maybe the second thing is, what can you get out of a capital partner besides just capital, right? And how do you identify who the right value added partner is, and what is it that you could perhaps expect, in that relationship post transaction? So talk about the first part. I'll try to do that more briefly. Kind of partly business decision, purposefully, and partly just, as a function of who we are. We focus on this industry, for better or worse. It doesn't make us better or worse than the next guy. It's just kind of who we are. There are a lot of middle market investment bankers who are just kind of generalists. There are firms that I know that are great firms who have a specialization, but it isn't by industry or vertical as much as it is geographical. They could be, very connected in the Great Lakes region or the Midwest if they're a, smaller, middle market firm. For us, it was a function of domain expertise and understanding the industry. Not only have I been living this lifestyle for 40 years, I was an operator for 6 years. One of my partners, Jeremy Friedman, was an M&A banker at Bear Stearns, and then invested solely in the health and wellness space, working for 2 different family offices before he joined Green Circle. My other partner, Bakley Smith, was a food and beverage analyst at Bank America and then at Jefferies. So this is kind of our thing, right? It's something we know some stuff about. It's something that we're just interested in. And from a marketing perspective, I think it's effective because your client company isn't looking to hire, a good banker, right? Or a good lawyer or a good accountant. They want the best guy, right? And the best guy for them. So there are plenty of firms that are much bigger than mine, but who would be the best firm for a 10, 20, $40 million food or beverage company? We think that we fit that bill. And because of our focus on understanding the industry as former operators, and then also within our network. And it's interesting because, when you're a banker, you get contacted. There's a million private equity firms and venture capital firms out there. And we get actually inbound cold solicitations to get introduced to these guys all the time because they're looking for deal flow. And this may actually sound funny to your listeners because, you kind of think about it as the guy who needs the money is chasing around the guy with the money, soliciting him, asking for money. Well, that relationship does turn around. When you're the company that's growing and kind of breaking out of the pack, with great growth, with products in the marketplace that are becoming highly visible, you actually start getting inbound calls the other way. For us as middlemen, we'll get solicited by companies that want our help. We constantly get solicited by investors who are looking to be included on our distribution list when we have an investment opportunity to share with folks. And the rule at Green Circle for the last 5 years or so has been, if they're generalists, we don't really track them or connect. We typically won't even, invest the time to do an introductory phone call. I mean, there are databases for those guys. I could run a screen on Preqin and find 1,000 generalist PE firms if I wanted to. What we've done over the years is focused on building deeper relationships with a smaller universe of investors who are folks who really focus either exclusively or primarily on natural products, food, beverage, supplements. Now, as I said, maybe expanding that into some adjacencies like restaurants, but even on the restaurants, it'll be better for you restaurants that are concerned about sustainability, using technology in a more effective way. So, we don't know every investor on the planet, don't maintain relationships with them, but we do know almost every investor for a growth stage natural food or beverage company. And we try to get to know those folks well so that we have productive and more, proactive relationships with them, so that I know not only are they going to pick up the phone when we call, but I understand them. I can be more effective in helping my client by knowing who's really the right fit for them, who might not be, by knowing not only the firm, its mission, its kind of infrastructure, its resources, but also even just culturally, the people behind the money, who would be a cultural fit with this particular client, which might be different than the next guy. And that's kind of a good segue probably to talk about the more important part of this question, which I infer, which is, how do you kind of find the right capital partner? What can you expect? What can you get from someone besides money? So, particularly in the venture capital world, there's a real, perception that firms try to purvey that they're much more than just money. That for the best deals, you should choose them and not one of their competitors, because they're going to do a lot more for you than just give you money. And there's kind of a spectrum. There's no black or white. There's no right answer, but there's what I would call like a spectrum between a passive investor, which is someone who literally intends to just write you a check and then leave you alone, for better or worse, not help you, but not bother you. And hopefully in 4 years, get a phone call that they made a bunch of money. All the way to extremely active investors who would insist going in on having board representation or participation, on having certain consent rights over what key decisions the company can make, and on playing a very active role, if not in the day-to-day management, certainly in the strategic oversight of the company at the board level, and also just on an ongoing basis in communication with the CEO and the leadership team. And then there's everything in between. Now, depending on the guy or the gal, on the founder, the CEO, the owner, what do you want in an investor can really vary, right? So many of the folks in our space, for a long time that were running the most exciting companies were first-time founders. People who were young, might be in their 30s, early 40s, maybe even in their 20s. It might be the first, company they started. We've seen tremendous founders who are running a business that is their first job out of college, and so what would that guy or that gal need? It could be a great deal. Is that person humble or, cooperative enough to invite that sort of support from an investor? So you kind of have to check those boxes, right? Is it someone who needs certain help? And if so, what is it? Is it someone who's going to invite that sort of help and a participative, sort of approach to managing the business? Or do they really want investors who just leave them alone? Well, we can find you a variety of different options depending on who that person, the founder, is, and what would make sense for them and what they think, would make sense for them. Now, I'd say most of your early stage CEOs, they do much more than not. They want active investors, and in some industries, there's like this perception that VCs can be like bad. They are going to try to tell you what to do. When the first sign of a problem, they're going to try to throw you out and steal your company. I can't really speak for other industries, but I'll tell you, it's been my amazing pleasure over the last 5 years. After 15 years at big firms on Wall Street, where I found that to be true quite often, and found a real arrogance among a lot of my colleague professionals, in the natural products world, it's the opposite. Most of the billionaires, billion-dollar funds, or the representatives who manage the money for them, I think the vast majority of them are great folks. And I have the pleasure of talking to the biggest investors in this industry all the time, who actually really care and have the same shared values that I do, that many of my clients do. Like, these are folks who really care about impact investing, not just making money, about the product being healthy, about what the company might be doing to help, save the environment, et cetera. So anyway, like I said, there's a big spectrum, but it kind of also depends on what the company needs, right? So is the founder, the CEO, the management team, are they folks who want active investors, or do they want to just be left alone? And if they do invite that sort of help, what is it that they do or don't need? Well, it varies greatly from company to company. I think the biggest determining factor is probably the background and experience of the CEO. And so in a lot of companies, the guy who launches the company is kind of a sales and marketing type who might need help in certain areas. But, again, they come in all stripes, right? So you might have the young mom or dad who just wanted to make a healthier product for their children, or you might have a real professional who was a financial professional who had an idea for a product. So based on what their strengths are, you can go find some help in capital partners who kind of specialize in certain things, just as much as you could in hiring vendors. There could be someone who doesn't know as much about trade, spend and execution, and they might hire you, but you could have a guy who this is his third rodeo, and he ran, sales or marketing at other companies before he launched this one. Well, that's not what he needs. Maybe there's some other stuff he needs. And there's, a great difference in certain firms with what they bring to the table besides just money. And we know, some firms in the space that are really great at helping folks with sales and distribution. Some that are really great when it comes really to marketing and to brand architecture. There are firms, we're discussing something right now with a firm that really kind of has an operations infrastructure that they provide to all their portfolio companies, almost like a shared back office. So it really depends on what the needs are, the interests are, and then finding the right marriage. And, we're not the only guys who do that. We have a few competitors that also know the space and know these people and their strengths and their resources really well too. But having a good advisor, that in the role that we play, can be really helpful in making the right marriage. That was a really long catharsis. Let me stop and ask what your question is.
No, I think that's great. I mean, this is why I wanted to have you on the podcast. And to go back, I mean, there's a lot to unpack here, so thanks. But to go back to what you were saying, from my background, working for big companies, et cetera, yeah, VCs did have a bad reputation. And the reason for that is because it was all about the money. That was it, period. How do I get my money back? And not thinking about how that brand really interacts with the street, interacts with customers. I give an example. I used to work for Kimberly-Clark, and the CEO came out and said that, hey, my greatest accomplishment was I never laid anyone off. We were so focused. We were very similar to a natural brand in that it was all for one for all. Well, the person that they put in place was all about the money. And he just started getting rid of people regardless. It doesn't matter. But you know what? The valuation, we look at our Wall Street. We were the number one brand in every single category that we competed in prior to that. They are not the number one brand, including in a lot of the categories that they created. My point being is that when you're saying that when you align with the brands that you're working with, that's so very important. And this is why I want to have this conversation. Thank you. Because it's those, it's people like you, investors like you, that understand the bigger picture, that understand, in the example that we're talking about, how, you can't expect a small brand to have a 99% ACV within day one, day two, whatever. But how do you get there? And then more importantly, we'll talk about this more in a minute, not only the velocity of the brand, but the contribution they give back to the retailer. So part of the question I'm trying to change in this industry, Stu, is instead of the traditional strategy where we focus on squeezing as much margin out of a single item, right? So let me back up a little bit. Retailers cannot possibly be an expert in everything they sell. So they need brands to help them understand who their core customers, et cetera. And so if I can help a brand, help a retailer understand and appreciate the value that they bring to the shelf, not only from that little sliver of space that they sell, that in real estate in terms of their shelf, but more importantly, how does that brand interact with other categories, other brands, other products within the store? And in our space, what's cool about that is that we have an opportunity to drive more traffic, more market basket sales, et cetera, to the store than other brands. So I really appreciate the fact that you've gone through so much of this. So let me ask you some questions. So when you're talking about how you're the valuation, one of the things that in the article that you sent me, et cetera, that I was looking at, you're talking about evaluation. You're talking about how there was a sea change in this industry. So what did it look like before and what does it look like now? And where I'm going here, Stu, the reason I'm going down this path, Stu, is that if I'm a brand and I want to find an investor, why do I choose you versus someone else?
Well, okay. So again, a couple of things to sort of unpack there. Let me get to the last part last, and I'll
Okay.
take on the first part first. What's the sea change? There's been a real evolution in the investment community's approach to this space. And in some ways, it's kind of come full circle, although I hope only in part. When I started Snow in 2005, the vast majority of institutional investors, the VC community, 90% of them wouldn't even pick up the phone if the deal was consumer. And there's a reason, right? These are CPG businesses are tough, with a lot of moving parts, a lot of execution challenges where things can go wrong, and with margins that are usually thinner than some other industries that have typically been most attractive to venture investment. In '05, I mean, even if you could find a guy who was open to consumer, you say food and bev, you made it harder. And if you said beverage, you got a dial tone. I mean, it was really tough. That changed, right? And what happened was there's been a revolution, as anyone who would be in your audience knows, in the consumer's approach to health and nutrition, right? In America, the Western world, and kind of everywhere, there's been a revolution in the way that we view food. And what was accepted for so long, you put sodium benzoate, potassium sorbate in my food, so that's fine. If, it's on the shelf in the store, then it can't be bad for me. Well, there's been this real, as you said, like sea change in consumers' awareness and approach to that. And so this natural and organic revolution led to, real loss in market share by all big CPG companies that make food and beverage products, all these legacy products. I mean, the last few years, 90 of the top 100 food and beverage companies have lost market share. So, and they're losing it to small and mid-sized natural and organic alternatives to these legacy products and brands. Well, and in some cases, there were strategic acquisitions where they said, instead of fight them, join them. And so we had these, like headline making acquisitions of, 15 years ago, vitamin water, at 10 times sales. A company who had maybe never made a profit was sold for this unbelievable valuation of Coca-Cola. And it was a very positive, event at the time for Coke stock, because soda was just beginning to start to decline and finally being acknowledged as unhealthy, right? So here was a way for Coke to start modernizing and diversifying their portfolio. Since then, we all know some of these marquee deals. Crave reinvented jerky with an artisanal option, and Sir Kensington's, kind of disrupted ketchup. And we had some of these deals where people made tremendous amounts of money, at valuations that were really newsworthy. Well, that brought, that got the attention of the investment community and brought a tremendous amount of venture investment to this world, food and bev, or, growth stage food and bev, that we really hadn't seen before. In fact, you and I spoke about this. I forgot where I read this, but there was a statistic a few years ago. I noticed in 1 year, the number of venture stage, deals that were done by different firms, the number of firms in venture stage deals in food and bev went from 50 to 250 in 1 year. So think about that, 5 times the number of, professional investors that would have invested in food and bev, suddenly were investing there. Did they understand the space? Did they understand the challenges and nuances? Well, some did, I'm sure, and plenty probably, underestimated how different this business might be from others. But that liquidity, like anything else, right? If you're selling a house or a car, the more people who want it, the more money chasing it, the higher the price goes. And so multiples on early stage food and beverage companies over the last few years driven to valuations that folks like me thought were crazy, right? And when I say folks like me, I don't mean guys who, like are smarter or know, because we don't. But I've been around long enough to have seen ups and downs, right, in markets which always cycle, whether it be interest rates or the stock market. Markets cycle. That's kind of just the way it goes. So we saw that valuation get stretched to levels that we had never seen, and it didn't make sense, right? And it got to where it was kind of standard that my office would get a phone call from a brand doing 5-7 million in revenues, not remotely close to ever turning a profit, and they thought their company was worth $20 million, and the lesson lost on those folks, and it's not the fault of the founders, it's the fault of the investment community, if anything, but the lesson lost on them was, business is supposed to make money, right? At some point along the way, profit is the key word. So this is a tough industry to generate any sort of positive cash flow until the business establishes real scale, kind of 10, 15 million plus in revenues before it's easy to really make a profit. So, we had venture capital money flowing into the space that drove the valuations on those companies high, to where we constantly had people who thought they should be able to raise money at 3, 4, 5 times sales, which is really high, compared to most normal metrics, most normal standards. That is turning around. And as you said, I mentioned in my article, we haven't even published it yet, but I just shared it with Dan. Last year, that was already turning around organically. And we saw a stat in the New York Times that the amount of capital that flowed into venture stage food and beverage in 2019 was half of what it was in 2018. When you take that kind of, volume out of the system, it's kind of like releasing air out of the balloon, and valuations absolutely were coming down. Anybody who's active in the space and, working on deals in our industry last year knew that as the year went on, valuation was starting to come down to earth and kind of normalizing. And then COVID hit, right? And we'll probably look back years from now and there'll be CEOs of companies that didn't make it who will say, oh yeah, it's because COVID hit. But that's probably not the real reason, right? Like COVID long-term is a positive for anyone who makes the packaged food product that's sold at grocery, not in food service, right? But it's been really disruptive. And it has kind of, put a realistic lens around valuation in every industry, at least to some degree. And so what COVID's done is not caused a reduction in valuation, but maybe accelerated. What was already kind of underway, it just, made it happen in a month or two when it might have taken another year or two. And where we are now is probably towards a more normalized world in terms of valuation. You can still raise money. There are definitely still folks in the industry who are looking to do deals. We launched a new process for a, $10 million natural snack food company in the middle, toward the end of March, like right when the news was worst and scariest. And we debated it internally and with our client quite a bit, whether this made sense or not. For a variety of reasons, he decided to go to market. And we found that there were definitely some, firms that were saying, hey, we're, just managing our portfolio right now. We got our hands full. There were plenty of folks who said, hey, we're open for business, send it over. We want to see it. And I'll tell you, over the last few months, that has changed substantially back towards normal, where, people now are starting to figure out the new normal, how they're going to do business, how they're going to navigate this going forward, seeing that the world hasn't ended, knowing that they're in a consumer non-durable, like food, where that's never going to go away, and that there's still plenty of long-term opportunity, and there's definitely interest in deals. It's going to be at more normal valuations, but that actually could, in the end up being good for everyone anyway. And I'll wrap up this long speech, I've been making several today, by saying this: it's really important to founders and to early stage companies to understand. I learned this lesson when I was an entrepreneur, and I've repeated it 1,000 times to other folks, but nobody goes out of business because of dilution, and it's interesting because, CEOs also run the gamut, between like super concerned about valuation and knowing that it's not necessarily something to obsess over and everything in between. But, we do a little matrix for our clients and prospective clients, showing them sometimes the difference in dilution to their personal stake in the company on the lowest valuation they think might be fair and their dream valuation. And it's stunning sometimes when they see on paper how little of a difference it really makes. And I can walk you through those numbers, but my point is, the vast majority of startups that fail when they run out of capital, right? So if that's the case, I have two pieces of advice. Stop talking so much about marketing programs you can't even afford, and focus on raising money and knowing what your strategy is for the next capital raise and laying the groundwork for how to make that, successful. And secondly, worry a little less about valuation. Make sure you get the money in the bank. Because if you are running an early stage consumer brand and it ultimately is successful, the valuation at which you did your Series A round, it means almost nothing, right? You're either going to fail, in which case it never mattered, or you're going to succeed, in which case those founders generally make tremendous returns. And a little bit this way or that way isn't the thing to focus on, when the risk in, turning down an offer that you think is a little less than it should be is, again, having a liquidity crisis. It's much more important to get the capital. And also, I guess I'll add one thing. And also, and I think this is your theme, Dan, and to get the capital from people that can help you.
Hmm. Absolutely. So let me see if I get this straight. You're saying that just because my mom loves it doesn't mean it's valued at some astronomical figure. I get that all the time. Thank you for unpacking that. I really appreciate it. One of the things that you mentioned, you're going back to how big companies are losing share. This is one of the areas that I like to focus on. We were talking about this before, Stu. The reason I believe that's true is because small natural brands are closer to their end consumer, and they're innovating based upon what the customers want, rather as thinking about how do they innovate to support their the supply chain, et cetera. How do they keep the lines running? And so in 2016, I was invited to do a feature article for the 2016 Category Management Handbook, where I was able to prove using all outlet Nielsen data that natural organic products are the ones that are driving sustainable sales across every category. And I used organic in that example, but plant-based, which is relevant to you. Those numbers are even greater. So the point being is that the small sliver of the pie that plant-based takes up of every category, if you take that out of the category, every category is flat or declining. And this, yeah, and but people don't, they overlook that. So we're talking about numbers and data and stuff like that before, and that's such an important factor. By the way, Dustin, I see your question. I'll make sure we answer it in a little bit. And by the way, please put in more questions. Thank you for doing that. But my point is, having someone like you that understands the business, understands the consumers, understands the lifestyle is so much more relevant than having someone who just gives you a check. Because what I find, Stu, let me know your thoughts on this, is that a lot of the brands don't know what they know, what they don't know what they don't know. And even the brands that had a position in like a Nestle or a P&G or something like that, that now get into the natural space, don't understand what this space is like. And those things that they don't know create additional bottlenecks and constraints, et cetera. So you were talking about, for example, the revolution in terms of the investment money and what's out there. I'm glad that things are getting to what you would call the more normal, the way that they should be, which I think is more fair, because the best defense against any virus is a healthy lifestyle, is a healthy diet. And so the fact that you understand that, as opposed to you looking at a brand as an ATM machine, is really, really important. So as you're working with these brands and you're trying to help these brands understand why you versus someone else, what do those conversations look like? And how do you help them get to the point where they understand that you are a value add just because you understand the industry? Then how do you help them understand that you're also value add because you have a big Rolodex? And then more importantly, because you're involved or invested in what they're trying to do.
Well, and to be clear, I think in this, conversation, we're not talking about how we're the value add green circle, but rather how because we're middlemen, right? We actually have a principal investing division to my firm called Green Circle Food Tech Ventures,
Mhm.
where we invest. We're the investor, not the investment banker, and we invest in tech-enabled businesses that disrupt the way that we make or distribute food. That's a newer enterprise for us. Actually, we closed on our first deal in January.
Cool.
Um,
By the way,
but to
if I may, sorry to interrupt, if I may, value add meaning you understand the business. So
Yeah,
an ATM machine that just spits out cash and you figure out what to do with it versus somebody that can help. I'm sorry, go ahead.
no, got it. But I also just wanted to make the distinction between, I think the value add that we're talking about that a brand is going to get is from their investor, not just from their banker who plays middleman to connect them with the investor. And I was just simply saying that we actually are investors in some cases. We're a merchant bank where sometimes we are the principal investor. Sometimes we're the middleman, the investment banker. Today, we're talking about the part of our business where we're the middleman, right? With a CPG brand, we don't make investments in those companies, but we broker them as middleman. So the value add that they're going to get from us is, and I'll make this really quick, yeah, it's knowing the industry, understanding their business, having been operators, being able to capture the essence of what's great about their business or why the challenges will be overcome, and be able to spin that in a way that's honest but is most attractive, to the investment community. And then again, by having focused on that investment community, in my case for 15 years, knowing who they are, what pushes their buttons, what their advantages, their resources, their drawbacks might be, and being able to thoughtfully advise our clients on how to navigate the process, how to extract the best price and terms, how to find the best partners. Now, the value add from their long-term capital partner, because once that transaction's done, in our case, we stick around and help our clients post-transaction for a variety of reasons, often because we become shareholders. But your real partner is the guy who gave you $5 or $10 million. What is it you're going to get there? Well, one thing, when we look at the loss of share by big CPG to these natural and organic alternatives and upstarts, one thing that's changed a lot during this time that we're talking about is that, again, going back to like when I started Snow in 2005, it's not like I was the only natural soda, but I got to tell you, there was only a handful, and we were all friendly competitors. Like I could name who they were, right? So what's interesting is when you're competing for crumbs, right? Like soda has over the last 10 years lost every year like around 1.5%, of that market share to healthier and natural alternatives. It's a market so big, it was like 70 billion when I started. Now it's probably like a little less than 60 billion, but still 1% is $600 million. 600 million in sales is being thrown up for grabs every year from what's lost by soda. If there were only 2 or 3 upstarts competing for that market share, could you imagine, how unbelievably lucrative that would be? But there's 100. Actually, in fact, in beverages, there's about 1 new beverage company created every day in America. A non-alc beverage trademark is registered about once a day. So if there's 300 companies competing for those scraps, that's a very different competitive dynamic than what there might have been 10 years ago or 20 years ago before this revolution really kicked in. So you have to be differentiated and not only be able to compete and, claw some crumbs away from these, older legacy brands that are starting to lose market share, but also compete effectively with the 100 other guys that are trying to climb over to you to get to those same crumbs. Mm-hmm. In addition, I always say, and I know that you'd agree with me, that the food or beverage industry is weird because having a great idea, that doesn't really mean a whole lot in any industry. It's got limited value. But in this industry, in my experience, having been an operator and having worked with a ton of companies since then, it really comes down to execution. It's the stuff that's not sexy that separates the winners from the losers, or like to use the football analogy, like these games are won at the line of scrimmage. It's the blocking and tackling by 300-pound linemen. It's not the, diving catch in the end zone, that makes the headlines, that really separates a lot of these brands. I thought your point about trade spend was astounding at the beginning of this conversation. Hundreds of billions of dollars that had so little effect because so few brands, especially smaller ones, really know how to perfect, implement, and then scale their promotional program. And if 40% of groceries in America are sold on promotion, isn't that important? Not necessarily your social media campaign that's gonna, may or may not be seen, right? Like at the point of sale in the store, you have such opportunity to do it right or to do it wrong. Anyway, to get to the heart of what you wanted to talk about today, there are firms that are really great at that. And I'll tell you, so first bar is, are these good people, right? Are these honest, decent people who want to support us and partner with us rather than just use my company like an ATM machine, as you keep saying? Well, that's a reputational question, right? I mean, there's pretty easy ways to actually do diligence on investors once you get down to a short list of folks who claim to be really interested and have done a lot of work, so that you see that they're not just talking, like they've invested time in getting to know you and to understand your business. Now, maybe these guys are serious about making an investment. It's not that hard to pick up the phone or to email the CEOs of their portfolio companies or past portfolio companies. And usually, in my experience, when you ask someone, tell me about you, people love to talk about themselves. It's not a hard sell, right? So you get that guy on the phone and you ask him or her, tell me a little bit about your business. What was your experience with ABC private equity firm? Sure, you're going to, whenever you're getting a reference, you'll get some sugar-coated version of the truth, but you'll start to get a sense, And in our experience as middlemen, in my relationships with investors, it's pretty obvious, actually. There are some firms that say to me all the time, hey, you know what? Tell your client they can talk to the CEO of any firm we've ever invested in. You'll see what great things they say about me and my team. Even just the confidence to be able to make that statement, there's got to be something behind that, right?
Oh yeah.
But also having trafficked in these circles for 15 years and 6 or 7 years actively as a banker, like, you just get to know folks, and you get to know what their relationships have been with other companies. And past performance isn't a guarantee of future results, but it is an indicator. It's directionally accurate. There are a lot of firms that I know, these guys really build great partnerships with their portfolio companies. These guys can be a real pain in the ass. And then, for a variety of different things in between and different reasons that it might or might not be a good match culturally, these are folks who really are aggressive. They want to go from 10 to 100 and sell it to Nestle within 3 years. Well, there are certain firms that could be the right partner for them and certain that wouldn't. Here's a team that this is a family business. They're concerned about risk. They don't want to take on debt. That could be right for certain investors and not right for others. Well, then also it's, what is it you need, right? And what could these guys provide to you? There are certain firms that we know that have incredible resources for some stuff and not for others. And again, it's just like finding, fitting together the puzzle pieces in a way that'll make for the best marriage.
Thank you for sharing that. In fact, on that note, that kind of helped me rethink how I wanted to put this. My point being that you should be doing you as the brand should be doing due diligence on the potential investor that the company is going to invest in your brand, which I think is something that's not talked about a lot. This is exactly why I wanted to have this conversation. So thank you. And then back to the point about execution. You're absolutely right. Majority of the brands struggle with this. And the reality is that, again, you don't know what you don't know, but because of the way the industry is structured, our supply system is so fractured. It makes it difficult for small brands to get on a shelf compared to big brands. And that's the problem I'm trying to solve. So thank you for that. Let me jump into a couple of the questions. If I don't get to all these before the end, please don't worry. We'll reach out to you and we'll make sure we answer them. So Dustin asked, for smaller companies, what have you seen as the biggest gap between those that end up being successful and those that rise fast and then fall fast? Stu?
Yeah, I'm thinking.
Okay.
The silence you heard was thinking. I don't know that there's, thanks for your question, Justin. I don't know that there's a standard answer. I mean, there's a line from Anna Karenina, the first line of the book, like, happy families are happy for the same reasons. Unhappy families are unhappy for so many different reasons. It might be the same case here. there's a lot of reasons that companies fail. I guess because he specifically mentioned rising fast and falling fast, you know, let me key on that aspect of the question and say, and also because we're here talking about finance today or how to capitalize your business, there's been a real focus as there was this liquidity available. You know, anything that was natural and had a good growth rate and or good velocity was able to get funding. Didn't really matter that you were profitable. I mean, I've heard people that I really respect who were really experienced, really smart folks advise companies to completely ignore the bottom line, which was always to me kind of odd, you know, being an investment professional for so long and having looked, you know, worked in other industries too, you know, it always seemed like there was some disconnect there between, you know, reality and perception. Almost like, you know, the music was bound to stop at some point. So maybe that's one element, you know, that's worth talking about. You know, there are smaller food and beverage companies that are profitable. We just had a client this year, some great guys that are friends of mine, that from the day they bought this natural food business when it was like $1 million in revenues, for 20 years in a row, they grew it very methodically and conservatively, never raised capital before, and every single year it grew for 20 years, and every single year it was profitable. Now, they didn't get rich, and they didn't have an exit like Crave, but there was never a juncture where no matter what was going on in the business, in the industry, in the economy, that they had to worry about whether they were going to go out of business that year, right? And now that company, you know, is, let's say, a $10 million business today with substantially positive, you know, cash flow at the EBITDA level, which is kind of unusual for a brand of that size. So I think what I'm getting at is today in particular, I think there's a real need to focus on bottom line, not just on top line growth. And that's not what CEOs of growth stage brands were encouraged to do for years by the investment community, because these deals were done on multiples to revenues and companies were financed no matter how much they were burning. You know, we've seen so many $5, $10, $15 million natural food or beverage brands that are losing $2, $3 million a year, and investors didn't care and were happy to write another check. Those days are over. I mean, there's been a real change in view on that sort of investing in the space. So I think there's a real onus on brands to get lean and to look at both top line growth and get to profitability in a way that really matters today. And that will prevent seeing, Justin's question is apropos to many brands that we've seen that get out of the box and get off to a great start. They're not building a sustainable business, right? Because they're not focused on bottom line. And also, I guess, you know, I mean, at the risk of stating the obvious, because they're not building distribution strategically, but rather opportunistically. So going to any customer that says yes, in any channel, in any geography, whether it's the right or wrong fit, whether it's going to cost a fortune in slotting and marketing spend that's required to go into the chain, they do it anyway. And that can lead to tremendous top line growth for a couple of years till that house of cards comes crumbling down, right? Better to take a year or two longer and build it with a stronger foundation. And at the end of the day, I mean, and we've talked about this too. In this industry, what has not changed is that the most sophisticated investors are very focused on unit velocity and not just on, you know, growth in dollars and units. So just going into new distribution, that's not really going to pay off long term unless you have a a program in execution for distribution, trade span, to support it in all ways that is going to make it successful as you go into that new distribution.
Thank you for sharing that. And my 2 cents, Dustin, thank you again for the question, is, and this is exactly
Help me out here, Dan.
No, I appreciate it. No, I think your question was great. I mean, your answer was great. And Stu, this is one of the reasons why our mutual friend, Michael J. O'Donnell, who's on the call, we did a course or put together a course about business strategy. And the point behind that, exactly what you said, that from my perspective, I believe that your business strategy needs to be so robust and so well thought out that someone else can come in and run your company for you on your behalf in your absence. The point being is that few companies have the discipline to do that. And so we were joking before about how a lot of the companies, when I read their pitch deck, it's, I just sold $5 last year and I'm going to sell $5 million next year, but they don't have a clear path to how they're going to get there. And to your point, and I love the way you put that, that word, opportunistic distribution versus strategic, that solves a lot of those problems. And it goes back to what we've been talking about all along in terms of how do you choose the right investor, et cetera. Stu, I know we're at the top of the hour. Do you have more time?
I actually have to go, but why don't
Okay.
I have a call I have to get to, but why don't we take one last question, because I don't want to
Okay.
leave on a
And
down
by the
note.
way, everyone, thank you. So what I'm going to do is I'm going to take these questions. I will share them with Stu, and then we will get back to you. So I appreciate
Glad
that.
to.
So anyhow, so Pete, thank you for your question. Pete says, hi, thanks for the amazing event. What are strategic buyers looking for as top line driven multiples return to realistic values? Good question.
Well, this could be the question.
Yeah, it is.
There's been, a real, concern and change in strategy at some of the bigger strategic buyers in this industry, because a lot of the acquisitions that we've talked about, I don't mean to pick on Crave, amazing brand launched by two really good guys, really smart guys. But John Sebastiani just bought the brand back for pennies on the dollar because it just didn't work, inside of a much bigger company. That's not a unique story, and it's actually interesting. I would separate food, from beverage. It's always been my opinion, as I'm kind of like a little bit of a beverage guy. I mean, not the expert, because we didn't really succeed, but I was in AAA, in the beverage industry for a while. So I know a little bit more about that kind of ecosystem. The beverage industry really, by the way, only non-alc is what I'm talking about. There really isn't robust innovation in big non-alc beverage companies. If you think about it, what's the last major innovation that came out of Coke and Pepsi? No offense to you guys, love you both. Maybe it's Diet Coke. When did that happen? In the 80s? I mean, that's a long time, right? Coke Black was an innovation. It failed badly. Invega was an innovation. Coke and Nestle working together, a drink that has, it takes more calories to drink it than were in the drink. So it's a weight loss product. They got sued by like a bunch of attorneys general. That didn't work. You could call bubbly a success, but I wouldn't say that seltzer is an innovation, with all due respect to Pepsi. So those guys have embraced in a big way the idea of incubating small brands. Coke's been, they've changed strategy there, but as they've had a robust program at VEB. Pepsi is doing some really cool and innovative things now, not only in beverage, but in nutrition more broadly, in health and nutrition more broadly, and not trying to innovate internally, but rather looking to entrepreneurs to do what they do, to like come up with the great ideas and work 24 hours a day. And when it bubbles up, out of the muck, they could step in and partner with them, buy them, etc. In food, it's different. And this has actually been a concern of mine for our ecosystem ecosystem of early stage natural and organic brands, don't count them out. You know, like big food has a rich history of R&D and innovation. So different from the beverage industry, most of your major food companies, you know, they have very robust innovation programs, R&D teams, multiple teams. And they're constantly inventing and innovating new product lines, new SKUs for existing brands. Do they need us? Do they have to pay 7 times sales? Couldn't they make a version of pasta that takes out the flour and puts in beans? Well, they did. The biggest pasta brand in the world is now competing with Banza and Explore Cuisine, a client of ours, because Barilla created a better for you pasta. I don't think it's as great as the guys that are my friends. But, you know, it wasn't that impossible for them to do that. You know, you see noodles made out of vegetables. Well, why can't Birdseye take a potato peeler and make some noodles out of zucchini the same way that Cece's did? No offense to those guys, great brand, but, you know, they did, right? And so there's, you know, a really complex dynamic in what strategics are looking for. I think that because they're capable in the food industry of innovating, and because there's been some marquee deals that have failed to create value, there's a real kind of reevaluation taking place at several of the larger food companies right now. I think you're going to see less deals done at less lofty multiples, particularly to revenues. And it's different, right? If it's really just a sizable business, you know, when our mutual friend, you mentioned Eric Skay, when he sold Rayo's, not only was that just an incredible breakout, like super premium brand, but the positive cash flow being generated with tremendous EBITDA margins, it was simply just a rock solid business in addition to being a high flying brand. Well, there's always a market for that, right? Because these guys are always looking to simply build cash flow, you know? So again, it kind of leads us, I guess, to maybe the same point I've made a couple of times in this conversation. This may be a time to really kind of focus more on execution and bottom line than solely look at top line growth, which had kind of been the norm in this industry for the last few years.
Good point. Thank you for sharing that. I know you got to go. I just copied all the rest of the questions. Thank you everyone for submitting those. I really appreciate that. Thank you everyone for being here. Stu, I really want to thank you for making time for us and sharing your insights and your wisdom. I'll be certain, I actually put it in the show notes. I mean, in the chat, how to get a hold of Stu. Do me a favor, everyone. Make sure you show up to the next week's free webinar. But anyhow, thank you again. I'll be making this available to everyone, and I'll let you know when that comes out. But anyhow, thank you so much. I appreciate it. Thanks.
Yeah,
guys.
Dan, thanks a million for having me. It was fun. Thanks for everybody listening. Have a great weekend.
Thanks. So expect me to reach out to you pretty quick with the rest of the questions, everybody, and I'll send them to Stu so he can answer them. So anyhow, thanks.
Bye.
Bye.